So today we're going to talk about tax-sensitive asset allocations and where you receive your income from in retirement matters. Again, we're going to talk about how to really look at this and again, there could be a lot of work that goes into this, but I want to just teach you. I want to show you what this looks like. And if you are comfortable doing it, great. If not, then reach out and get some help to get this squared away. Okay, before we jump in, as always, I have to let you know this is not tax advice, legal advice, financial advice. This is for educational purposes. And I have to protect myself here by putting this up, but hopefully you enjoy this today and you find some value in it. Okay, here, these 7 words, you might have heard me say this before, but I really want you to take this to heart, okay? And this is kind of the theme for this whole section. And really, this is the theme of what we do when it comes to retirement income planning with our firm. But not all money is taxed the same, okay? Not all money is taxed the same. Different sorts of income are going to have different types of tax rates, and different places that you're going to be funding your retirement from you're going to pay different taxes on those sources. For example, as I showed you before, if you sold a stock off that was outside of your retirement account and you've held it for a year and a day or more, you're going to pay a long-term capital gains rate on that of 15% most likely. If you've held it less than a year, then you're going to pay short-term capital gains, which is basically your normal marginal tax rate. If you take money out of your IRAs and 401ks, you're going to pay your full tax rate. If you take money out of a Roth IRA, you pay no tax, right? As long as you meet the other qualifications. So not all money is taxed the same. We're going to talk about this a little bit more in depth, but I want you to take this away and kind of take this to heart as you're looking at these things, okay? So we're going to talk today about sources of income. All right, so sources of income here are... we got interest income, okay? So interest income, again, we'll dive into these things, and you're probably familiar with this. So think about your 1099-B, I believe it is. When you used to, a year or two ago, actually get interest on your savings accounts, right? Remember we used to get that at some point, and now it's like 0.0003, and it actually costs you money to leave money in the bank. Yeah, so interest income is one of the worst types of income to receive, by the way, but that's one type. Then we have pension income. And we have dividend income, capital gain income, tax-exempt interest, and Roth and insurance income. Okay, so these are the 6 types of income that we're going to be discussing today. Okay, so interest income. This is money that you receive from your money market accounts, for example. So money markets used to be a good place to hold short-term cash, right? They used to pay a little bit. They might pay maybe 0.3, 0.5% if you have a good one. But, it's still that interest is taxed at the highest rate. So that's your full tax rate. Corporate bonds are taxed at these rates here. U.S. Treasury bonds are taxed at these rates on a federal level. And so some of the attributes we need to think about is that you're going to have annual income tax on the interest. Okay, so this can really be a surprise for people, especially those of you that are going to be retiring early, before 65, because you have to stay below those earned income limits so you can qualify for a ACA or an Obamacare tax credit or a subsidy on your healthcare. So this can really blow up a plan if you really try to push your IRAs, for example, your IRA income to the limit, and then you get a distribution because you had some high interest money market or treasury bonds or something like that you're holding outside of your retirement account. But the key is you're going to have to pay annual income tax on this. Versus an IRA or other types of accounts where that interest or that income tax can be deferred until you decide to distribute it. This is going to get distributed annually, and that could be a problem if you're trying to control your income at any particular time. And so this is taxed at the highest rates, okay? So your top rate is what this will be taxed at. So it's great to get a little interest on some of your savings. That's nice. But at the same time, you're going to pay the highest possible tax rate. So it's not the ideal place to hold money if you have other options, okay? Right. Our next type of income is pension and IRA income. So these types of income are what quite a few are you going to have here. So we have pension income. So if you receive income from a pension, that's basically normal income. IRA distributions are another type of income, and that's going to come out against your full tax rate. Profit sharing plans and annuities. Those are all things that are going to come out. So some attributes of this type of income is that you do generally get tax deferred growth. Okay, so IRA income is going to be tax deferred, which is nice. But then when you go to pull it out, you're going to pay your full tax rate. A downside to these types of accounts are you're going to have an RMD. So if you never heard that terminology before, RMD, that stands for required minimum distribution. Okay, so these accounts at age 72, now if you're not 72 yet, are going to have a required distribution that you're going to be forced to take out whether or not you need the money. Okay, so many folks I speak to here have pretty simple lifestyles and they're good savers. And so by the time they get to 72, they may not need their full required distribution. And so for them, this amount of income is really going to add a lot larger tax bill than is necessary if they would have done just some planning ahead of time, which would have been the right thing to do. So this is what we focus on a lot. We call it your golden window from when you retire until you hit about 70 or 72 to get some control around the RMDs, because I don't like not having as much control. The other thing here, another attribute of this type of income, is that there's no step up upon death. Okay, so what does that mean? If you have stocks, for example, and let's say you bought your stocks for, let's say you have $100,000 that you put into your stocks. And let's say when you pass away, those stocks are now worth $500,000. Well, under current law, which this might change by the way, but under current law, if you pass on that $500,000 to one of your children, for example, they're going to receive what's called a step up in basis. So if they sold all that stock off within a few months of when you passed away, they can receive all that money tax free. And that's a nice thing. But that might go away. But the things with IRAs and pension income and 401k income is that when you pass those on, those are going to be 100% taxable. And thanks to the Secure Act, which came in 2020, now all of that income that's inside of your pre-tax IRAs, 401ks, TSPs, whatever it may be, that all has to get distributed within 10 years of when you pass. So not only is there no step up, it also has to get distributed within 10 years. So if you leave behind a big IRA that's in a pre-tax account, that could be a huge tax bill, and you might be giving away 30, 40, maybe 50% of that money if you have a large account you're leaving behind. So not really a great thing. Another attribute of these types of accounts is that there's early withdrawal penalties. Okay, so for those of you that want to retire early, there's a lot of folks that have just been great savers, they've been great investors, and they want to retire at 53, for example, because they have enough money. Well, with these types of accounts, there are some ways around it, but generally before 59 and a half, you're going to have to take a early withdrawal penalty, which is 10% of the balance that you withdraw. So you could withdraw and have to pay your tax rate and then an additional 10%. So that's not great when you have these type of accounts. So you really want to look at having possibly some alternative accounts to pull from if you're looking at retiring early. All right. Our next type of income we're going to talk about is dividend income. So generally, I like dividend income. Dividend income is usually coming from stocks, right? So if you have dividend paying stocks, if your income is above that 40,000 and change mark for being single and above 80,000 and change for being married, well, then you're going to have to pay 15% on any dividend income that you receive. But if you're below those amounts, then this will be tax-free to you. So that's a good thing. But generally, it's going to come from stocks. And some attributes of these types of accounts are that qualified dividends are taxed at long-term capital gains rates, right? So 0, 15, or 20, depending on your income. You do get a step up in basis at death for things like single stocks. So these will pass on and there'll be no tax to whoever inherits those. So that's a positive. And now we will move to capital gain income. So capital gain income is pretty common. Most folks here are going to deal with some sort of capital gain. But when we look at capital gain income, we're going back at stocks could have capital gain income. Mutual funds and ETFs have capital gain income. Real estate sales can have capital gain income. So if you're selling your primary property and if you are a single filer and you've made over $250,000 in gain on that property, then you're going to pay capital gain income or capital gains taxes on anything above that $250,000 amount. If you are a married joint filer, then you have a $500,000 exemption, and anything above that $500,000 increase in your home, you will pay capital gains taxes on that. And for any sort of rental properties, you don't get that same exclusion. If there is gain over your basis, then you're going to pay, again, capital gain income on that. Some attributes of capital gain income is one nice thing is you get tax deferral until sale, right? So that is a nice thing. So you are not required to pay taxes every single year on capital gain income unless you decide to sell. So going back and comparing that to our interest income, where that's going to get distributed every year, there's a benefit here to keeping money in things like stocks or mutual funds or real estate versus just having it sit in a high interest checking account or a money market. because you can defer the capital gain income until you decide to sell. Another attribute is that you get the reduced capital gains rate, right? So that capital gains rate is 0 or 15 for most people, 15%. For some, it'll be 20, but most people are going to pay 0 or 15%. So that's a nice benefit as well. And then accounts or mutual funds, real estate, and stocks at this point do get a step up in basis at death. If you watched my update on the potential new Biden tax plan, that may be going away for some people. So we'll see what happens there. So that's something to keep an eye on, that if you do have a lot of real estate or you have stocks and things like that you might be leaving behind, you might want to look at some other strategies to help you alleviate the burden of that tax in case that does go through and you have money to pass on or real estate to pass on. Okay. Our next type of income we're going to discuss here is tax-exempt interest. Okay, so tax-exempt interest, you can think about muni bonds, municipal bonds that are issued by state and local government entities. So these can be good for investing, or getting some sort of return on some safe money that is outside the wrapper of like an IRA or a 401k. So tax-free munis are usually used for that. Challenge with bonds now is that we're really going to see a drop in the returns on bonds, and we're pretty much going to be looking at receiving the coupons or just the interest. We may not see a lot of gain in bonds, but there's still some opportunities out there, especially internationally. So setting up your bond portfolio in a way that makes the most sense for you is a good idea. But what we're talking about here is municipal bonds that can be potentially state tax-free. Federal tax-free. So some attributes there are they're federally tax exempt. They can be state tax exempt, but they could cause tax on Social Security and Medicare premiums, okay? So this is a tricky one because, again, if you search in a group here for provisional income is the income levels. If you earn above those amounts, you could potentially pay 50%, up to 50% of your Social Security can be taxed at a certain level, and then up to 85% of your Social Security can be taxed at another level. So when you're looking at your overall income, your AGI or adjusted gross income, muni bond interest is counted in that. Okay, so this can again push you over that limit, and $100 or $1 over that limit, and now you have to pay tax on 50% or 85% of your Social Security income. So these are things here where it starts to get a little tricky, when you're looking at all these different income sources. But if you're aware of these things and you can plan ahead, and you set up a good retirement income plan that can help you map this out, then you can really avoid this stuff and have a much better overall outcome and situation in retirement. Okay, and then the last category we're going to talk about here is Roth and Insurance. Okay, so when we talk about Roth and Insurance, we talk about Roth 401ks, Roth IRAs, and cash value life insurance. I generally don't recommend a whole lot of cash value life insurance unless you are maxing out every sort of retirement vehicle possible. But there is some benefits to cash value life insurance, if you want to use that in additional for additional tax deferral. But that is another way to get some tax-free distributions at some point. So you do get tax-free growth in these accounts. That's a benefit. You can get tax-free distributions as well, which is another huge benefit. And they are a tax-exempt payout at death. Okay, so for those of you that have been around a while, you've probably heard me talk a lot about partial Roth conversions. There's actually 5 types of Roth conversions. But the idea there is that you're going to get some of your money from your pre-tax account, like your pre-tax IRA or 401k, over to a Roth IRA, which can then grow forever tax-free. And there's no requirements to take money out of a Roth IRA at 72. There is requirements to take out of a Roth 401k at 72, which I think is my next bullet point here. So there's no RMD for Roth IRA and insurance, but there is an RMD for Roth 401k. So if you have a Roth 401k, you're going to want to move that to a Roth IRA before 72 to avoid that RMD if that's what you're trying to do. And then when you pass on these accounts, the beautiful thing is there is going to be that 10-year distribution window to if you pass it on to a non-spouse beneficiary, just like the IRAs. But this can be a completely tax-free distribution. So that can be a really beautiful thing for whoever you left this money behind to. Right. Okay, and now let's kind of bring this all together here. So what this chart is going to show is essentially from left to right, the worst to the best, okay, types of income. So this is what we went through. We just covered this right now. But if you look at the worst type of income to have in retirement, generally, it's going to be the interest income, because that's going to be taxed. That comes out every year. There's no control, and it's taxed at your highest marginal tax brackets. The next worst type of income is going to be pension and IRA income. So 401ks, IRAs, those type of incomes, because you're going to have to pay your full tax rate on that, whatever that ends up being at that time. Then we move to dividend income. So dividend income generally can be good, but it could be 15%. So that's not bad. Capital gain income, similar there. You could potentially pay 0, but you can, again, around that 15%. But the nice thing with the capital gain income is you're usually dealing with things like stocks or mutual funds that you have tax deferral until sale, whereas the dividend income, that's going to pay out every year. So those generally, that's income that you have to take essentially off of those. So that's why capital gain is ahead of dividend income. And then you're going to have tax exempt interest. So generally that's very good income to receive. Federally exempt, could be state exempt, but it could cause tax and so on your Social Security and your Medicare premium. So that's a big deal. And then we have our Roth income, which is generally the best, right? So that is like tax-free growth, tax-free distributions, tax exempt payout on death, and there's no RMD at 72. So Roth accounts are a beautiful thing, really, really useful. Okay, so now I'm going to talk a little bit about designing your income streams here. So, you've probably heard, most people have probably heard of asset diversification. So having stocks and bonds in your portfolio, or having, U.S. stocks and international, right? You want to have, asset diversification. Definitely, most people have heard about that. But in retirement, I also want to bring up the idea that you want to have tax diversification, because tax diversification can be very useful when you're looking at some certain situations. Having different buckets for different time periods can be very useful when you're in retirement so that you can achieve the following. So, for example, if you are looking to retire before you're Medicare qualified, so before 65, and you're able to keep your income below the limits, it's 400% of the federal poverty level for most states, and then there's some states where it's 600%, like California, it's a little higher. But you can potentially save $12,000 to $16,000 per year by keeping your income below certain levels. So if you have no other choice and all you have is an IRA, and that's where all your money is going to come from, well, then every dollar is going to be taxed, so you have to be a little bit more careful. But if we can get you set up with a few other buckets, because you have some time before you're going to retire and you have some time before 65, well, you can really save a lot of money by having some tax diversification. And the next thing is avoiding IRMA penalties. So IRMA penalties are what happens basically if you earn over a certain amount on your your MAGI, your adjusted gross income. If you earn above a certain amount, you could potentially pay a penalty on your Medicare premiums. So if you have high income, it's a 2-year look back essentially. So if you have a high income, the Medicare system is going to look back 2 years. And if you get this wrong and you go too high, you could be paying anywhere from an additional $860.40 to over $5,000 per year. The $5,000 per year is a very, very high income, by the way. So most people will be between $860 and like a couple $1,000s per year. But still, who wants to pay an extra couple $1,000s for insurance every year, all because you didn't plan appropriately, right? So these are things you want to watch out for. And if you have different income streams and you have tax diversification, this can help you avoid tax on Social Security payments. And like I mentioned before, up to 85% of your Social Security income may be taxable. So this is something you really want to be looking ahead at and setting yourself up before the end of each year, or really at the beginning of each year as well is fine. We're in February right now as we're doing this workshop. You still have time for this year. If you haven't distributed all your income streams, we can really look at where you should be pulling from, what order, to help you set yourself up so that you can qualify for potentially a subsidy for healthcare early, or avoid some of these other penalties we could be looking at here for Medicare or Social Security. And then the other thing is, we really want to be able to control your tax brackets each year. By having tax diversification, we can do things like help you stay below, a 22% bracket for a year and keep you in a 12% bracket if we can pull from different accounts. If you have everything in one account and that's all you're ever going to have, you do no planning, you might get stuck in one of the higher brackets for the rest of your life. But if you're somebody who is, early in retirement and you're before 70, there's still time. And the closer you are to 70, the less time there is, and the earlier you are, the more time there is. So whatever that time is going to be, we call that your golden window opportunity to do some tax planning to get you set up so that you can really set yourself up for those later years and be in a lot better position and pay a lot less taxes, hopefully later down the road. And in my opinion, with all this money being printed, we printed over $4 trillion last year. Looks like we're going to print another $1.9 trillion that was passed by the House recently. So we're talking $6 trillion that's going to be printed in a matter of less than 2 years. Okay, this is over 30% of all dollars that have ever been printed in the last 200 years. So inflation is something that's going to be very real, but the possibility of higher taxes coming in the near future is something that's very real as well. So really want to try to get ahead of this stuff and get you set up with as much tax diversification as we can. So then depending on whatever's going on in Washington, we can have a strategy for you where we can pull from one bucket or another to help you get yourself set up in the most strategic way. So that's what I have for you today. I hope this was helpful. Let me see if there's any questions here, and we'll talk about that a little bit. All right, so let's see what questions that we have. So if you have questions, by the way, go ahead and put those in the chat now, and I will talk about those. And if what I said, what I went over today with you is, resonating and all, and you want to get yourself set up for a better tax situation, if you have everything in one account, like a pre-tax 401k or pre-tax IRA, I would highly recommend you set up a call. So I'm going to put up my website for you. Actually, it's right here. So you can find me at keepitsimplefinancial.com/talk, and you can set up a complimentary call there to discuss. That's all the questions I'm seeing for today. So if you'd like to set up a call, I will put the link down in the chat there. I really appreciate you watching today. It means a lot to me as you guys show up to watch. I really love doing these, by the way. I really enjoy them, so hopefully you enjoy them as well. And my goal for you is just to become a little bit better every single week so that when you get closer to retirement, that anxiety level, that sort of like nervousness that I see a lot of people with is reduced. Okay, that's all I'm trying to do for you here. And you could probably take all the videos I put together and hopefully figure out a strategy. But if you want some help with it and you want help putting a strategy for you together that's very customized for your individual situation, I'd love to speak with you and help you out. You can find me at my website there. Okay. Other than that, we will have hopefully a great weekend, and I'll see you guys next week. And if you need anything at all, send a message or set up a call. Okay. Have a great day. Bye, guys.